The 360 on Energy and Carbon, hosted by 360 Energy. Tom Rand's focus is on carbon mitigation as an entrepreneur, venture capitalist, author, and speaker. He is co-founder and managing partner of ArcTern Ventures and sits on the board of a number of clean energy companies and organizations. Tom is a regular contributor on Canada's leading opt pages and television, and you will often see him standing on the stage, waving his arms as he speaks passionately about the intersection of climate risk and economics. Now let's get into the episode with Tom. Today we're joined by Tom Rand, co-founder of ArcTern Ventures.
Nice to be back, Lysandra, and I'm looking forward to continue our discussion with Tom because we're going to start talking about money and the opportunities going forward in this whole area of clean tech.
Good to be here. I look forward to the conversation.
So, Tom, I'll start this off right away. Can you share your journey from founding the Cleantech Advisor at Mars Discovery District to becoming the co-founder and managing partner of ArcTern Ventures?
Sure. I mean, what happened was that back when Mars was under the leadership of Ilse Tronick, Mars wanted to get into clean tech, which means they wanted to kind of give advice to clean tech startups and do what they were doing in the IT and health sciences space. I had just sold a software company about 18 months earlier. To date myself, I helped invent voicemail. So back when voicemail was high tech and MS-DOS was the platform of choice, I developed a lot of that software. And having sold that company, I kind of had a chance to reinvent myself. And I'd always been an overeducated observer of climate, scientifically literate family. Why aren't they listening to the scientists? And so I had a chance. I had a very inspiring dinner. Actually, it was a World Wildlife Fund donors dinner, sort of a private Northern Circle, I think it was called. And the 12 people there. And there were people there who were really inspiring to me. I mean, there was Jane McDonald, who had led some of the Kyoto Protocol discussions and negotiations for Canada. Toby Heaps, the founder of Corporate Knights, was there. And I sort of thought, well, these people are actually on the ice. And I just felt like an overeducated observer. And I thought, I got to do something here. And Toby actually challenged me at the end of the dinner. And he made some comment about running a fund. And at the time, I had no idea what that even meant. I didn't know what he was talking about. Probably our fifth pint, but I sort of stuck in my head. And I found myself at Mars really because I wanted a place to hang my hat. I was an independent entrepreneur until that point. And this is kind of the first job I'd had as an adult, having, and I thought, well, I'll have a boss. I'll go to work every morning and I'll just, and this institution seems like it would have my back and help me figure out how to be a bigger voice in this process. I'd done an Action Canada fellowship in Ottawa, which works on policy and sort of how you step up on that as a potential leader behind the scenes or in front of the scenes. And that had just inspired me to think bigger. So I landed at Mars and after a couple of years there, Ilse Tronick gave me a lot of freedom to I wrote a book and I started speaking and I began to wave my arms around on TV a little bit. And there was a vacuum there of scientifically literate business leaders who were willing to talk turkey about climate. I mean, you want to talk about climate as an existential risk, that was kind of Greenpeace. Jeff Rubin was willing to talk about the end of oil, but he had to leave CIBC to do that. So there was just the business community was not in front of the public talking turkey about this risk. And so I filled that vacuum fairly quickly. But I also found while I was at Mars that there was very little early stage capital for what I was building with the clean tech practice. Lots of enormous potential, really great entrepreneurs and great technology, but there was no money. There's zero money at that point for clean tech. I mean, Silicon Valley had fallen on its ass on clean tech and that was shutting up shop. And in Canada, I mean, unless you were doing a mining wildcatting play somewhere, there's just not much angel money either. So I did some angel investing in a few of these companies, including Hydrostore and Morgan Solar. But that's a very ad hoc solution to what I thought was a systemic problem in this country. And so ArcTern was fun. I'd met my partner, Murray McKeag, at that time. He was a volunteer advisor in the Mars services. And I said, hey, let's start a fund. Let's solve this problem. So at the time we did, and Greg Kiesling stepped up, John Love stepped up, a few of the local entrepreneurs, deep-pocketed angels came in alongside us. We put our own money in as well. And at the time, I mean, 30 million seemed like a lot of money. So fund one was 30 million bucks. It turns out it's nothing. So we raised follow-on money on top of that in special purpose vehicles from the same investor group, our George Butterfield and these patient, long-standing supporters of ArcTern who deserve big exits and they're going to get them, supported us as we built out that portfolio. And that portfolio I mean, that's Hydrostore, it's Woodland. These are some of the bigger plays that we've got, in terms of infrastructure. And those horses are just now starting to find their legs around the track. I mean, that's been 12 years. So these investors in Fund 1 are very patient and getting impatient now. I don't blame them. But that platform started. Then we raised our second fund in 2019, just before COVID hit. Opened up an office in San Francisco. And then we raised our third fund just kind of last year. It's a $450 million fund. So the platform of Arcturne has gotten pretty substantial. We have big institutional investors behind us now. But I always remember where we came from, which was, humble beginnings at Mars, supported by basically individuals with deep pockets who took a chance on us. And so the platform is a reflection of their faith. And I think some of the bigger success stories coming out of Fund 1, like a Hydrostore, is to the credit of those investors who came in on Fund 1, which was a long time ago.
So just picking up a little bit, because it's quite a history you have here, and the growth of the fund has actually increased in size. Is that because of the nature of things are more positive and more interest in this whole clean tech, or is it because there's just more people that are actually looking at clean tech as far as it's possible?
I would like to say it's due to the brilliance of the partnership at Arcturne, but timing matters, right? So no, I think I noticed a huge change just after we closed our second fund. So Murray and I were talking on the phone. COVID had just hit. And we were having a conversation about, should we shut up shop for 6 months and just wait this out, or should we keep going forward? And the decision was to keep going forward. So I remember the timing of that phone call. And at that time, we had just closed our first deal in Parity. And that deal was just like Fund 1. We were the only fund at the table. So we wrote a check and we owned it was like the old days. We're kind of acting on our own. There was maybe 5 or 6 funds in North America that did what we did. So we were often by ourselves. There are now 200 funds globally, more announced every day, that do climate tech. So the shift between pre-COVID to today is fundamental. I think there's lots of reasons for that. There's a lot of pent up energy, I think, but partly, honestly, I think at that time, Greta Thunberg was running around empowering kids to have more participation and more clear-headed participation in the questions they were asking around the family dinner table. Everyone's at home. COVID had hit, so we are feeling vulnerable. Maybe nature's in charge a little bit. I think we were asking ourselves, what are our lives about? What are we doing? Our kids are there. Climate's getting worse. And something happened. Something snapped culturally. Now, it couldn't have snapped and moved that quickly without a lot of work that was already being done. You can't raise $1 billion fund in 6 months. I mean, so I think the groundwork had been laid by a lot of business leaders for a long time, some of these leading lights in the sector. But I think something snapped in terms of that potential energy becoming kinetic energy on the capital side, because there's been an explosion in capital availability for this sector. And I think that's also been matched by customer demand in the market. I mean, prior to COVID, if you had a machine that replaced a fossil fuel machine in a factory, you had to be a tenth of the price. You had to be so robust because you're bringing operational risk to a big money-making facility, and people don't want to take operational risks. It's against every bone in their body. And that changed. If you bring a solution to market today, I mean, you still have to be robust and you got to be economic, but you don't have to be a tenth of the cost. If you just have a marginal benefit, there's demand for what you've got. So the demand side is more robust today. The capital side is way more robust today. It coincided with COVID. Was that a coincidence? I don't think so. I think there was something culturally that shifted inside us about what are we doing and why are we doing it. And I think a lot of it has to do with, what is now a young woman in Sweden, Greta Thunberg.
Very good. Thank you.
Could you elaborate on ArcTern Ventures' investment philosophy and the types of clean tech startups you seek to support?
Yeah, so it's evolved over time, but ultimately we look at GHG mitigation. So every deal we do, we look at the potential impact over the short term of that technology. And we also look at its link to economic viability, right? So we invest in companies that can make money, and we invest in companies that can reduce emissions. And the two get linked together. So we have a impact report we produce that is a direct link between, the profitability and scale of this company economically with its impact on the environment. Now, we love, like every venture fund, the sweet spot, which is, high margin software, SaaS, ARR kind of stuff. So for sure, there's a bunch of stuff there, but we don't shy away from bigger bets too. We do them very selectively. You can't have 25 out of 25 companies that are swing for the fences infrastructure plays, but we selectively pick them out, and every fund's got a couple of those, Fund 1, Fund 2, and Fund 3. And then we look at leadership. We look at the team like everybody else. I think in Fund 1, one of the things that we did was we were techno optimists in that we thought, if the technology is brilliant, you can build a team around it. Whereas today we take more seriously the notion that, the team that you have in play is critical. We look at the successes of something, again, I'll go back to HydroStore or Woodland. I mean, it is the personalities at the heads of those companies that got them to where they are, even though it is true that the techno-economic analysis is valid, right? We figured out what HydroStore was going to be and so on, and it's true. But without a team that can actually deliver that in the market. So we take more seriously, but now as we've matured, the team. We really need to see a top team. We want to see revenue now. We're a little later stage. We're not seed anymore. We're probably a seed fund in Fund 1. Now we're a classic Series A, Series B, building a portfolio. We save a lot of our capital for follow-on investment. So we'll probably get 25 companies in Fund 3, and we'll do a lot of follow-up investment on those same companies.
So this question might be redundant based on what you've just said, but Tom, when you assess the potential of an early stage clean tech startups, what are the key criteria do you look for opportunities?
Yeah, so again, we're looking at their environmental impact, and we link it to their total addressable market. The subset is a serviceable addressable market, and then what we think they can reasonably expect to get of that market over the next 10 years, and we link that directly to GHG reduction. Now, some companies are more of an enabling technology. So a company like a Parity, so Parity does energy efficiency in buildings. It's a direct GHG reduction. So you can measure it, it's immediate. Other companies are more enablers of emissions reductions, right? So even a HydroStore, it enables renewable power on the grid. There are other technologies like Span, which is a beautiful piece of hardware for the house to integrate your solar panel in your car and the grid and your smart appliances and so on. So it's an enabling technology for a smarter energy home, for example. So we sort of look at these tertiary and secondary effects and kind of tamp them down a bit in order to sort of not overstate our goal. But no, and this is really a lot of work due to Murray McKeag, my partner, who really decided to quantify in ways that our investor base can understand the impact of their dollars in terms of GHG reduction, cost per ton, and so on. I mean, ultimately, when you make money, the cost per ton is negative, right? You're getting paid to reduce carbon, which is the nature of a venture fund. But Murray really said, Arcturne wants to set a new standard in the market for how we measure impact, because there was all kinds of reporting. Some of it was qualitative and arm waving, and Murray's like, no, we're gonna be quantitative, and we're gonna be. And so I think Arcturne has done some really good work to set a standard in impact reporting. And we link that directly to the economic upside to our LPs.
Just a quick follow-up, because exposure that I've had with some of these venture funds is typically they have a short window, but you talked about 10 years, which was caught my attention. Is that common in the venture fund, or is that just unique to your organization? And maybe it's changed as you've conveyed.
Well, I have two answers to that. One is, the second and third funds that we raise, we have a 10-year horizon, and I think that's probably reasonable. Again, going back to Fund 1, we were ahead of our time back then, and we've had to extend the fund a couple of times. Again, our long-suffering, supportive LPs, George Butterfield, I love you. It's longer than we thought, right? And it's going to be, by the time we get a real exit on some of those, it'll be another 2 or 3 years. So it's a 15-year fund. That's a long time for investors to hold. Fund 2 and 3 were a 10-year fund. That's probably I think what's changed, not only is the market timing better now, right? That the market is there for Woodland, it's there for HydroStore, it's there for Green Mantra and so on. But I think now there are more players in the private equity space to step in and pick up the baton as you want to exit. So there's a more robust ecosystem for Arcturne to hand off, basically exit a company to somebody else who's going to keep building it. And I think that ecosystem is healthier now. We're going to start testing it this year, next year, as we look for some exits in Fund 2 and Fund 1. But I think 10 years is probably about right. But yeah, Cleantech's a long game. And as an impatient entrepreneur, I'm always surprised at how long it takes to get this ball down the field, and how far down the field you got to get this ball before somebody else picks it up. In Fund 1, honestly, I thought if I prove the technology and I get an installation and I demonstrate the techno-economics, Siemens, GE, someone's going to drop out of the sky and buy this thing. And that's just not how it works. You have to get that thing to the 2-yard line before you're going to get some help. And that's what we're prepared to do now. And by God, that's what we're going to do. We're going to get these companies to the 2-yard line. And if no one wants to pick it up, I'm going to run it into the end zone myself.
Fair enough. And just the last part, as far as a sweet spot with your particular organization, and is there a certain dollar amount that you will only look into, like whether it's 10 million, 20 million? Is there a sweet spot that you guys are interested in?
So our check size is five or 10 on the first round. And then we have follow on of up to sort of 20. And we like to invest in consortiums. So that means you can do A rounds. A rounds are bigger now. We invest all over Europe and the States. We invest everywhere. And A rounds are 20 to 30 million, 40 million now. So we play in that space, write a check for 5 or 10, have a lot of follow-on capital up to 20 or 30. And our LPs are very deep pocketed. So if there's a bigger play to be had, perhaps our LPs can step up and play there. And in terms of the company itself, we look for sales now. We're not, we'll make exceptions, but they're rare. We want to see 5 million in sales. We want to see a product market fit and a team capable of executing, and we'll support that team.
Okay, great. And one last part, which is there any particular countries that you find are, I think you mentioned before, and our experience is similar, that Europeans tend to be way ahead, but are they ahead on the clean tech, or is that open? Like, is there any particular country that tends to be really good at this?
Well, it depends on from which perspective you ask. In terms of IP production and opportunities, they're everywhere. It used to be Silicon Valley or nowhere. Like, you can find companies everywhere now. We have a company in Czechoslovakia, and we've got Sweden, and so technology comes from everywhere. I think clean tech is a very widely dispersed, more homogenous set of opportunities for us. But in terms of market engagement, different countries have different sets of market engagement. We don't like to invest in technology that requires policy and regulatory framework to be used. Like, we want these companies to compete in the market, but markets are different. Energy prices are different. Ease of regulatory compliance is different country to country, but that varies very much by the technology. So there's no pat answer to this. But bottom line, if you're not playing in the States, you're missing the biggest market on the planet. So even if you're a European country, you gotta get over here at some point. But yeah, it's a mixed bag, I would say. But it's much more homogenous than it used to be in the IT side, where you had to be in Silicon Valley and that was it. And Twitters and rainbows and so on. This is much more horizontal and much more geographically diverse.
Okay.
Tom, what trends do you foresee the clean tech industry taking, and how does Canada's reaction differ from other countries?
I have some horses that I've bet on that I think will begin to be. I've mentioned biogenic sources of chemicals and biogenic carbon capture. I think that's going to be a big thing. That's one of my predictions. The ability of us to take carbon out of the air is real. I wish the DAC industry all the success in the world. There are lots of different players in DAC. I think the winner is going to be ones that leverage natural systems, but can leverage natural systems in a way that the carbon captured is measurable, verifiable, counterfactually valid, blah, blah, blah. So you can putting it in the ground effectively. So that's one big trend. The other is that one of the hard things to do in climate tech is to acknowledge that most of the work is going to be small, $500,000 to $2 million projects inside factories, inside buildings. Again, everywhere you use energy, you're going to change what you do. So this means it is a massive engineering effort, project by project by project, and they're small projects. So it's very difficult to write a check that begins with a B when you're aggregating projects that begin with a T or an M, $500,000 to $1 million. The built environment's a great example of that, right? And so I think the financial innovation and the engineering innovation, and in order to reduce the friction costs on these deals, right? Because if you're doing a $500,000 energy retrofit, I mean, just the legal, the financial, the engineering, compliance, bringing in a third party, I mean, it's $200,000, right? Those projects, that's not a ball that's going to roll downhill. So I think the innovation will be on how engineering and technology providers engage in the market to reduce that friction so that you can aggregate engineering and financial efforts on these energy efficiency and energy retrofit projects. Because that's a big piece. I mean, we all talk about solar panels and storage, and I mean, we're going to build infrastructure for sure. That's a big part of what we're doing, decarboning our grid. But on the energy use side, this is more than half the battle. There's no climate scenario that I've ever looked at that doesn't have half the lift being done by efficiency. And efficiency is on the ground hard work. It's wrenches and boots and wires and bolts and pipes and so aggregating that activity so that it becomes frictionless to some extent, and you can aggregate it financially, so you can lower the cost of capital, you can lower the cost of compliance. That's where I think a lot of work needs to be done. And there are some folks like Chrome, Colestat, and Toronto that are beginning to do it in a way that, partnering with the bigger companies like a bank. Or if an engineering company who can deliver on those projects can partner with a bank and decarbon their entire portfolio, now you're talking about a decade-long transition, right? But that's a lot of legal and engineering, financial nuance to get that done in a credible way. And I think that's where a lot of advantage can be had.
I'm so pleased you talked about efficiency. It's, for years people have talked about it, and I, for some reason, feel, because I've been in the business for a long time, that it's actually faded. And it's one of the biggest things and the biggest returns, which you had mentioned in our first podcast. Just people don't measure it. They don't actually figure out the return. They look at, okay, what incentive did I get to change or modify, but they don't measure it year after year. And as you said, the return on investment is massive. So I'm so pleased you brought that up. But coming back to that, and one of the reasons why I think it's lost some of its luster is I think the C-suite doesn't appreciate or accept that this is real and that there's a business return on investment to do this. So my question to you is, how do we effectively advance the C-suite executives to start prioritizing activity, whether it's efficiency or the energy transition, to achieve the net zero? Tom, what's your magic sauce?
I have a really easy answer for you. And this one question, unlike all the others, there is a magic bullet.
Okay, good.
The magic bullet is this. I mean, CFOs are taught in business school that, energy, that to only use their capital budgets for strategically important projects, right? That's your capital budget. If you're a t-shirt factory, a strategically important budget is a t-shirt machine or whatever, right? And energy costs on your income statement is just not of strategic importance. Unless you're an energy company, it's just not. It's just an input. So any energy efficiency play has to hit the operating budget, which means you need paybacks of 9 to 12 months. You haven't really got the attention of anybody upstairs on this issue. It's just an operational line manager thing, and you've got to empower some, mid-level, operator to sort of do it. And there's lots of those people doing it. But 9-month payback, I'm going to change a light bulb. Once you have a change of heart and you say, actually, this is the magic bullet. The CFO just says, actually, that energy line is of strategic importance to my company. It's of strategic importance to my company because it's a big input. So it should just, but also we have carbon risk. We have lots of future risk. We have asset value risk here. It's a building operator. My energy use per square foot plays into the value of my building. Same as a factory operator. So as soon as that switch happens, that line item is now of strategic importance to this company. The CFO then says, great, now I can tap my capital budget. And now you could basically get to net zero or near net zero, and you can generate a return on that capital budget that I'll bet you dollars to donuts is more than you're going to get with any strategically important project you could build, right? If you're a CEO, CFO team, and you're getting more than 15% return on your equity, you're a rock star. Energy efficiency blows 15% out of the water most of the time. And so that means you're going to get a higher return on your investment if you tap your capital budgets. So there's a magic bullet. CFOs just need to see energy use as of strategic importance, and that changes everything on the efficiency landscape.
Totally agree. Our challenge is to educate them and make them aware that is the value, for sure.
That's right.
To end off this episode, I actually have 2 questions for you today. First one, what advice would you give to entrepreneurs looking to break into the clean tech sector?
Well, the first one is don't think of clean tech as a sector. If you're an entrepreneur, do what you're good at, be great at it, earn a position in the market economy where you've got some influence, and then use that position of influence to change what's happening around you. I say the same thing to kids who are graduating. How do I get into clean tech? Just follow your profession, be good at it, earn the right to be influential in whatever company you end up at. In that company, you can affect the emissions, right? Forestry, ag, movie making, restaurants, doesn't matter. So again, it goes back to this notion that clean tech is not a sector. It is a massively horizontal new way of doing business where you take energy seriously and take greenhouse gas seriously. So any entrepreneur in any sector can play there.
And lastly, what is the biggest takeaway for our listeners?
I think that last piece is the biggest takeaway, right? Where we think about this thing as a soup to nuts. Everybody, the last episode we ended here too, and there's a reason for that. This is an all hands on deck moment, and I think every actor in our society, never mind our economy, has a role to play here.
Thanks, Tom. Dave, what's your biggest takeaway?
Yeah, I like what Tom said. I'm just going to add another piece because I like price signals too. And the fact, Tom, you're saying that more and more venture funds are getting into the market to help out. There's a reason why they're doing that. There's money to be made to do so. And so it's telling me the price signals are there and that this is just going to keep on rolling. So I'm really pleased to hear that this is happening and happening in the speed, which I didn't realize. So that's great to know. And then reinforcing what we said last one, if companies or employees or any professions, they need to start thinking about this because it is going to impact them, and it could be a very positive thing if they take advantage of it.
Yeah, let me actually I'm based on your last comments there. Let me change what I'm saying too. Let's make no mistake about this. This is the biggest economic opportunity of the 21st century. That's it. I mean, there is no bigger economic opportunity is that we're replacing a $6 trillion a year industry that is the lifeblood of the global economy, and we're going to replace it in 20 years. And countries and companies that figure that out and get a piece of that pie are gonna win economically, never mind environmentally. So yeah, this is a massive economic opportunity. I am a huge bull on clean tech. I can be bearish on climate. You've got me there a couple times. So this is a hard thing to do. But on climate tech, we're going to make boatloads of money because we're blowing away an incumbent industry that won't exist in 20 years. So, that's the scale of this opportunity. Let's get on it.
Agreed, Tom. Thank you for this. It was fantastic.
Happy to have the opportunity. Thank you.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360 Energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn posts. See you next week.